Thank you, each of you, for joining on a Saturday evening, where we generally spend with families and on our personal priorities, probably to understand about India's investment strategic change, and maybe some of the tax implications related to these investments, how fraudulent investment schemes are working around us, and how we should make ourselves protected from those frauds and scams which is around us, and some of it, like methods of tax management, efficient tax management. All this could come as a topic today. So, like Soumya said, the importance of financial planning is what we are going to start with, and how the world is evolving to newer investment methods, and how things are shaping up. So, if you have any questions today for the session, please type it down then and there, if you're okay with it, and in the chat box, and the team will put out those questions as the first one to start the conversation when we open for Q&A. And wherever you have, you can leave your because there are a lot of people have joined without registration. We appreciate that, and please put your contact number, etc., so that people can reach out to you in case you have a doubt or in case you need further clarification, etc. Meanwhile, I am requesting Soumya also to leave the common mobile number or email ID in the chat, so that people can reach out to us if they wish to, for further clarification. So we'll keep it going. Uh, so the first thing before we get into financial planning, we should look at it: who should advise you on financial matters, or who is advising you on financial matters? Is it that social media today, which is very, very powerful and relevant, are they advising you? Or there are friends and relatives advising you who had a good or bad experience on financial management? Or there are finance influencers? Are they the one who is advising you? Or is it a sales driven advisor where you see it day in and day out, right? In online, offline banks, insurance companies, wealth management firms, mutual fund advisors. So who is advising you? So I can't tell that which advice is right or wrong, because everything, there has to be certain things which is good, certain things can be bad. So you are the one who need to depend on a qualified advisor, so that you are, if you are ill, I keep often tell this: if you want to learn something, you'll go and join a school, join a college. If you are ill, you'll go and meet a doctor. If you require a legal advice, you would go and meet a lawyer. When it comes to finance, everybody seems to have a say in that. So my request to you, as a prudent investor, as customer, depend on one or more right set of qualified financial advisors, and ask for expert opinion, ask for tax advice, ask for, and make him accountable, and make it cost effective, and ensure that every risk associated with that decision of investment, or taking a loan, or doing some other thing related to finance, the risk factor need to be addressed properly and asked properly, clarified properly, before you take up any financial advice from anyone. So depend on a right qualified advisor for all your financial matters. Right? This is the second piece of advice for the day, that in our lifespan, when you look at it, in 20s, we all think that too early, just got a job or about to get a job, is too early to have a financial planning. At 30s, we believe that it is setting up a family is important, and getting married, having kids, etc., is important. So we will do a proper financial planning later. And at 40s, the children take over your financial decision. And in 50s, possibly there is an emergency which comes and knocks you. And 60s is too late for you to start a financial planning. So my request to the audience today, that whatever age you are in, at least start now, and make your children also aware about the importance of financial planning. Recently, we came across a very genius banker who talked to us and said today the biggest problem in India is that children are either fed completely by the parents, so that they are kept away consciously or unconsciously that from the financial planning aspect. My request to all the audience today, that involve your kids in financial planning so that they understand how important it is to get into the financial planning at an early stage and get part of financial decision making, right? So that they will be able to stand on their feet as they grow up. So, like Soumya said, we've conceptualized and brought out a concept of FinSeed, which is a financial education platform for children in the high school and higher secondary school. And if something has given you the so much of satisfaction for us in this profession, is about that course which we designed. And the kind of and it is our wrong assumption that kids do not understand some of these concepts, but kids understand, children understand financial discipline very well. So teach them at the young age. Next time when you join for any of the financial management session, get your children also along with. And to sum up, please start your financial planning at an early stage, not when it is too late to do. And third piece of advice for today to start off our conversation is understand the discipline of financial management. To teach you or to tell you about the discipline of financial management, let me take this example of compounding, power of compounding. These examples are here. What we're showing it here is of no importance. Just to draw the point that if you are starting, say, an SIP of 5,000, in 10 years time, possibly with a average return of 10-12%, it can give you a lump sum of 10 lakh against an investment of 6 lakh. So the point is not the percentage of return, but on an investment of 6 lakh, you're able to create a alpha, create a differentiation of another 4 lakh. But if you keep continuing that investment for 20 years, right? You can see it here in this pattern. I don't know, people who are looking at the mobile phone may need to, zoom it out. 20 years against an investment of 12 lakh, you would be able to drive home a 40 lakh kind of a approximate amount. These are all, just don't look at the percentage of return. This is far better. We've taken a very, very conservative calculation just to make you understand the point. And if you are keeping the same thing for 10 years against your 18 lakh investment, which is 5,000 into 12 months into 30 years, 18 lakh investment, that amount crosses 1 crore. And in 40 years, the amount investment of 24 lakh, which can work out to 3 crore. So the point, the more you stay invested, more you keep investing, even with the same amount of return, that will produce multiplicity, power of compounding. Coming to the second point of cost escalation, please keep it in mind that today's cost is not what you will be charged for the same service next year. India's average inflation hovers around 6% plus. So every year, what does it mean to you is that your cost of purchase of goods and services will increase by a minimum of 6% looking at the past data. And in future, this could be much more higher, or the chances of going up or reasonably maintaining at 6% is very high. So ensure that 10 year down the line, whatever you are planning for an activity or a goal, cannot be achieved with today's cost factoring. You will have to keep a 6% compounded rate for the next 10 years, so that cost, if you intend to complete the task with 10 lakh today, it might cost 20 lakh in 8 years time, or 22 lakh in 10 years time. So remember, whatever cost you are planning today will not be sufficient to do the same goods or services purchase or construction of a home, or by building up a car, etc. next 10 years down the line. So this is especially applicable when you plan for your retirement. We've seen people with a limited income of pensions believing that this will stay after 20 year, 30 year. We've seen them struggling not to meet their monthly expenses because that fixed amount of pension will not be helpful, for future. So you need to plan for an increased cost escalation as the time passes. The third one is rupee cost averaging, so that whatever investments you do today, do next year, do 5 year down the line, gets you an average rupee cost averaging, which means your purchase price will be moderated over a period of time with ups and downs of the market. So three things again repeating. One is power of compounding. Stay invested and stay for long. Stay invested, stay for long. Second one is factor cost inflation in everything you plan for 5 year, 10 year, 20 year down the line. So that because there is something called a inflation which will hit you. Third one is keep investing regularly to meet the average pricing of a stock, average prices of a market, and don't fall for quick money traps. The whole cry which we have today is that people have lost money in um, cryptocurrency trades. There are certain exchanges which has gone bankrupt. There are people who solicit your money to invest into penny stocks, which is that single rupee stocks, etc. If you have money, and today speaking to the affluent people and the doctors, the engineers, the NRIs. So generally you are a big target. Yeah, every day in office I get at least 5-10 calls saying that you will be your trading income can be double. We will help you to earn higher trading income. We will help you with new ventures, right? Joint ventures, business deals, what not. So, and peer-to-peer lending, that lending, this lending. So, wherever you're putting your money, please understand that you're taking a risk, and you need to take a calculated risk with understanding a point of diversification, point of where to cut your greed off, what is the risk mitigation mechanism, the regulator behind it. So, we discussed that going forward in one of the slides about 5 R's, which we recommend. So please don't fall for money traps across us and the greed, the fear, and free and herd mentality. So greed is what puts us all of us down, saying that this is not enough. Let me go for the more one, the easiest one. And there are people who teach you the free. Everything I'll do it free. Trading income, I'll create you free. Currency exchanges, I will do trading and get you free money. So there is no free lunch, nobody will offer you. Fear, doing on the about the risk and doing nothing is also a risky terms. So which is also a money trap. The doing nothing, that my capital will be at risk. I don't want to put into equity. I don't want to put into NCD. I don't want to put it into real estate fund because everything is risky. And putting the money into a bank deposit, earning 5% is also a money trap. And the herd mentality. What is herd mentality? Generally, people will run with whatever the other person says. It could be an office colleague. It could be a church or a social member. It could be a neighbor. So everybody seems to be like, whoever says, Acha, go for this penny stocks, which will give you X return, everybody we will see that going behind that. So avoid these things. Just be careful about losing your money. I mentioned it to you already that inflation in India is very high at 6%. And so everything you factor for tomorrow, keep this inflation or cost escalation in mind, so that your goals for tomorrow should not be short lived or should be half done. So plan accordingly so that your future goals are met always. And this is what, in our experience, this is what we can tell to you, that avoid these common mistakes. Avoid greed and comparison. Create your own financial goal, create your own goals, and achieve through your own financial management. Your plan need not be equal to your neighbors. Your financial management techniques need not be equal to your parents, because you will have to live your life. You will have to create your own goals, create your own investment style, financial management style. Avoid comparing with others and then get into traps. Be prudent on loan management. So financial leverage is very good. I'm not telling you because I was a banker or I'm a banker. Because I'm telling you that every successful company which you look at it, they would have taken a loan, they would have raised capital from different people, different entities, etc. But only for a right productive purpose. Avoid excessive borrowing, and if you're taking a loan, ensure that the payment is done in time. Okay, otherwise, the kind of cost which will accumulate and you will have to shed out will be pretty high. Third one is expect uncertainties. Life is full of unpredictableness. So ensure that your portfolio is diversified. Your portfolio has to have risk mitigation mechanism. So COVID has taught us, pandemics have taught us, natural calamities have taught us, global warming and climate change has taught us. So there is a lot of uncertainty around our profession, around our life, around the education, around the jobs in itself. So ensure that sufficient backup is created, sufficient risk mitigation tools are created as part of your financial management. Independent decision making is important. The fourth one, which we want to tell you that this is where we started. Who advises you on finance? Do your own research. Ask every possible question before you take a decision on investment. There is nothing which will end tomorrow, so that you need to invest or you need to take a decision today with a half information. It is better to be an informed decision maker rather than a ill-informed, half-informed decision maker. Let others do not influence you. Yeah. So the next thing which I'm going to take today as part of the strategy today is, what is this India growth story which people are talking about, and are we all benefiting out of this India growth story? So you can see from every mainstream media stating that India is growing, India is making a huge ride in our, the global GDP forecast. IMF is saying India is the fastest growing one. So let us look at it. Having seen that, what are the minimum requirement for a proper financial planning? We are getting into something on India specific now. So India has celebrated recently 75 years of its independence and expected to be the next, to achieve the milestone in 2047 with 100 years. So it is an interesting data which is published by Niti Aayog, which states like this, that India's population currently is 140 crore and expected to be 165 crore in the next 22 years, 23 years. By 2047, India's population is going to increase. Median age, which is currently at 29, and I don't know how many of you know that India is having the youngest population among the large populated countries in the world, 29, which is expected to grow up to 37 in the next 20, 25 years. Life expectancy, which all of us need to factor in. Why? 71 to 84. So we tend to live more as the time passes. So don't think that all of us will die fast. Many people come back and say, no, I may not live up to that. So I keep telling them that, even if we have a cold, we would want to consult the best super specialty doctors. And thanks to some of the doctors around here attending today, they are the reason for it, extending the life expectancy to 80, 85, and maybe 90 for the people who can afford a better healthcare. Working age population expected to increase. This is very good. So that more participation in the labor force, in the productive space will come in. So what it attracted me is last few things, which is GDP values is expected to be 10 times more in the next 20 years. Probably our parents have not seen this kind of a scalable growth as far as GDP expansion is concerned. People wouldn't have seen this kind of a per capita income increase from a $2,000, $2,400 to $18,000 expected to be in the next 25 years. So, which means what? Individuals will have more money at their dispensation. They can spend more. In an age of 37 at India's average level, we would have those people on an average will have more cars, more flats, more consumption, more foreign tours. So India's GDP is going to multiply from 3 trillion, 3.5 trillion to say $30 trillion in the next 25 years. So this is a very big news and good news. And while many of the countries, you can see, I'm just jumping upon one slide here, that many of the countries where you can see GDP growth is expected to come down. Look at the Japan Eurozone here, UK Eurozone here. While it is expected to go up by just 0.5 to 1% in GDP, while US is expected to grow around 3%, India is expected to grow around 6.8 to 7%. Today I saw some of the rating companies have upgraded India's GDP forecast for 2024 to 7.2. So India is the fastest growing economy in the world, and it continues to hold so in the coming years to come as compared to many of the European countries, even many of the other Asian countries as well. So read this along with the kind of population dividend what we have, which I was showing to you, that people will produce more, consume more, thereby the economy is expected to expand big time, possibly in the next 20-25 years, by the time India achieves its 100 years of post-independence. So India's growth story of 10 trillion, which is expected to be in 2035, it's going to go up. Now, what India did, India started mimicking China, the way in which China made a big stride in economic growth as far as with the manufacturing base, with creating a strong manufacturing base. India is following the suit all through from 2000 onwards or 2010 onwards. Through service sector, India has become the sixth largest and currently at a fifth largest, and India is expected to be third largest economy in the world by 2030. We have seen that earlier. So story is that how me and you are can see this kind of a development. You can see the development with your digital transaction, with the kind of infrastructure highway network growth, with the kind of foreign direct investment. India has become a favorable sweet spot. GST collections, which is like all-time high. Even your small shopkeepers are able to collect GST and pay to the government. Corporate debt is coming down. Electrification is improving. In capital market investment are it has gone up by multi times from in the last 10 years. You can see a large amount of such kind of a growth happening around us in infrastructure, in digital transaction, in the banking space, in foreign direct investment, in GST collections, in capital market participation. We were just looking at the other day another number on IPOs. This year so far up to November, 221 IPOs companies have come out with public issue and collected 1.6 lakh crore. How much? 1.6 lakh. 1,61,000 crore they've collected from capital market, from me and you this year in India. It is one of the highest so far. So India's lot of companies are coming public, putting up a lot of things on, you and me to participate in the growth engine. This is what just I mentioned. India has the youngest population in the world today, and India is expected to have 51% of the people. You can see on the right hand side this red highlighted area. By 2030, India is expected to have 51% of the people in upper and mid income group to higher income group. So we will have eliminated, we would have reduced the core poverty lines much below, and we would have uplifted a lot of people. So many of us sitting here, I can vouch that in the next 10 years would have become crorepathies and multi-crorepathies. So that is the power of having a large populated country, having a large skill improved country with a large labor participation and per capita income increasing, which is enabling people to spend more, earn more, spend more, consume more, so that you will create an expanded GDP, and you will create a lot more people on affluent and HNI categories. So, how me and you can participate in this India growth story? Broadly, we can classify them into 5 different strategies, which is by participating in stock picking. Just now, I mentioned this year alone, 221 IPOs, 1,61,000 crore they collected from me and you, which means lot more companies are able to raise capital from the public market because of retail participation, increased participation in stocks. Through mutual fund route, we've seen all-time high in the last 10 years. From an 8 lakh crore, currently it stands around 64 lakh crore mutual fund investment as compared to what it was 10 years back at 8 lakh crore. So mutual fund is a good pooled vehicle which professionally manage and invest into different stocks. Third one is, of course, advised portfolios. Advised portfolio is nothing but strategies which are suggested by registered investment advisors, and they will buy stocks on your behalf. Couple of stocks they'll advise you and maintain that, and they will advise you when to buy, when to sell, which one to add, which one to hold, etc. For portfolio management service, generally known as PMS, is another managed portfolio. Like the word says, there is an investment manager, portfolio managers who manages the portfolio strategy in your and mine account, and we are able to generate a better return with a those who can afford to have a sizable income. And the last one in this series is alternative investment funds with a minimum ticket size of 1 crore. Again, there are qualified SEBI approved managers, which we are seeing it in detail, will be able to advise you on stocks and invest into different stock portfolios. So we are seeing some of it in detail. So as part of financial management or financial planning, there are 4 or more areas one need to look at it. So one being investments. So investment is a core area which takes care of, which has to manage, which has to be managed well for you to earn return, a better return, inflation beating return, higher end of the market return for your wealth to grow. Having done your investment, there are times you will have to leverage on your wealth created to take loans, and further it should generate more return for you. So loan is a separate area of financial management which require you to accelerate your wealth. Third one is de-risking. So de-risking, there are 2 parts of it. Why I'm just mentioning you before I get into in detail is that de-risking has 2 elements. One is earlier we have seen avoiding from frauds and risk. Your hard-earned money should be de-risked from frauds and scams. Scamsters. Around us, so many scamsters. We need to be extremely careful about. Second one is the life unexpected things, which we have also seen that life has got a limited certainty now due to various changing situations. So we will have to have our health risk management in place, our own life risk management in place, our own personal risk management in place, critical illness risk management in place. Even there are companies today offers corporate directors risk mitigation programs like legal risk, otherwise responsibility risk, product risk, etc. So risk management is a vast subject which you require in today's world, and retirement planning, because like we mentioned, People would retire one day and still will expected to live 80, 85, 90 as the time progresses. And one need to have a regular income post retirement. So these are four aspects of largely on financial management. So how did our investment style changes? First, we are going to consider the investments. So traditionally, India has been known for investing into gold, yellow metal, which we call, used to call it as. Often it was a hedge against inflation. People, ancestrally kept gold, transferred to the next generations, and people had a habit of buying one of the largest amount of gold, and as a popular wealth creation mechanism. Second was chit funds. Everywhere, Kuri companies, Nidhi companies, chit companies were running. So this was, another type of past wealth creation methods. Fixed deposit, which is very, very traditional, and people are very happy with, putting into nationalized other banks. And last one is real estate. So if you ask me, while I was in the bank, we were all very happy that they taking deposit left, right, and center. And deposit and real estate used to hold the largest part of wealth in the past, but things are changing now towards, So let's look at some of it. So what is the change which so many of us were able to bring in? So there are banks which transformed investment habits. There are wealth management companies transformed investment habit. There are portfolio managers transformed investment habits from self-managed investments here to managed portfolios here. So self-investment styles, we used to have business, on stock picking, on trading. That is paved way to professionally manage investment vehicles like a mutual fund, portfolio management, alternative investment. Thereby, what did that change? It was given to somebody to manage it professionally, like a legal case, we give it to a lawyer, like a illness, which we go to and meet a doctor. So investments started coming to the professionally managed people with a higher diversification, risk mitigation, and which is producing consistent return and gives you a lower risk. So this is a big paradigm shift. And among the shift, the first strategy which we are going to discuss today, we are largely going to discuss four different strategies. One is mutual fund. So while it is very, very common, India has 40 plus mutual fund companies operating around 2,500 schemes, right? And having 64 lakh crore invested by me and you into mutual fund. Mutual fund can be invested by SIP, monthly SIP, and lump sum amounts. So I'm very happy when I talked about SIP is that when we started recently, we as a firm has just completed 1,000 SIPs in the last 3.5 years time. And in terms of value, there are customers who are willing to write a debit note or a SIP of 5 lakh a month. 5 lakh is so far our highest SIP. So I'm just saying that there are customers willing to come forward and create wealth through systematic investment programs and or through lump sum. Any period, short period and long period. So when I talk about short period, I must tell you that, do you know that in mutual fund investment can be done for even for one day? There are funds called overnight funds. There are funds called liquid fund. There are funds called short duration fund, debt funds, all government securities funds. So there are funds which can cater from one day to say 10 year, 5 year, 3 year. So depending upon your tenure, what you are looking for, one can always find you the right set of mutual fund schemes. Anytime withdrawal. This is like I mentioned, one day today you can put and tomorrow you can withdraw. There are four schemes with available which will give you, which will facilitate that. So anytime withdrawal options are available and any combination. You don't have to take any mutual fund, I mean, even mutual fund with equity risk, stock risk. There are mutual fund with the government securities. There are mutual fund which only invest into NCDs, corporate bonds. There are mutual fund which invest into gold. So you can choose a variety of investment strategies today, and your portfolio looks like this. It might have some bank stocks like this. It will have ETF like this, gold ETF. It'll have NCDs like this. It'll have bonds You can see it here, a combination of. So there are various combinations of mutual funds available today to create wealth for you on a longer term. So next slide, we are going to talk to you about some actual data of how mutual fund versus direct stocks versus fixed deposit versus gold. If somebody had invested a 5 lakh rupee in 2022, how that would work out to in 2024. So we've recalibrated this. So it is not 2027, it is 2024. So this 5 lakh would have become a 3.63 crore, 3 crore 63 lakh. Against a fixed deposit would have given you a 22 lakh, and a gold would have given you 35 lakh of investment return in 20 years time, 22 years time. So you can see mutual fund here has grown at 21 percentage. This mutual fund, particularly HDFC Top 100 mutual fund, we have taken as a one reference point just to draw a point to you. This is not an assurance that in future this will be this is the best mutual fund and it will give you 20%. That is why the disclaimer is it is only an illustration to show you that past return has been how the return of different investment schemes and need not and it is not an assurance for future. So the point which I am driving is mutual fund, a well-managed mutual fund can create return better than FD, better than gold, better than direct stocks. And one need not be only that lump sum amount to create a higher amount of wealth. You can still have SIPs, monthly SIPs, which can create wealth over a period of time. So here is a case of 5,000 rupees SIP in 20, 30 years, how it would create a 3 crore, 4 crore number with actuals. So, like I mentioned, you can choose different approach based on your need, your disposable income, your investable income. You can choose whichever the scheme you need to create wealth over a longer term, with mutual fund as a strategy one. I hope the strategy is clear to all of us. Like I mentioned, we'll have to have a stop at 8 o'clock. So I'll try to increase my speed. Second is portfolio management. Portfolio management, which I mentioned, PMS, is an investment tool with a minimum 50 lakh and having a personal view of a professional PMS manager, picking up the right stocks in your demat account and able to generate a higher return with a higher risk. I'm very candid saying that this is the investment required for people who can take higher risk and higher return. There are the best mutual fund, portfolio management companies. And here also, you can see the number of stocks. And mostly, PMS would be driven on stock-related pick, while there are debt-related funds are there. But the most popular is stock-related, high-risk, high-return portfolios like this. You can see some of the returns. So again, the caveat is that past return is not an indicator for future performance. So you can see benchmark beating returns in PMS. So the second strategy and third strategy is more aligned. So I'm going to spend more time on the AIF front. Alternative investment is a elder brother of a PMS. If PMS is 50 lakh, alternative investment require 1 crore of minimum investment size. So thereby it caters to the high income group of people which has an ability to take higher risk and ability to get higher return. It is a specialized investment opportunity, generally can invest into pre-IPO funds, which means mutual funds or any other public, large promoted pooled investments can only invest into listed companies. So in this case, there's an option to invest into pre-IPO stage itself. Before IPO itself, companies comes and meet with AIFs to solicit investment. And there are credit funds, there are real estate funds. And the taxation benefit is in AIF is that AIF taxed at the fund level, not at the individual level, which means the fund has to calculate the tax and pay it before it is released to the investor. Right? And there are some of these partners are, very well known investment partners, specialized investment vehicles called alternative investment fund. Some of you may not have heard about it because it is relatively a new strategy which has come up in the equity space. And there are established players who manages and family offices who commit their money for alternative investments. So this is very, very popular among the high net worth group. So I just wanted to take a minute in telling you that based on the investor risk appetite, based on the investor investment style, one can decide under AIF to take Indian equities. So there is a strategy. Among AIF, there are different strategies, and we broadly classified them into five. One is Indian equities. Investment can go into Indian stocks, listed or unlisted. Minimum investment time period should be anywhere between 4 to 5 years. Okay. Return here is a past return. Again, past return is not an indicator. That is clearly mentioned, but I'm just saying past returns, you can see it in a range bound like this. There are working capital funds called performing credits. So people who do not want stocks, who want to lend money, there are vehicles, AIF, which lend money to companies against a fully secured route and get you a reasonable return of 12 to 15 percentage, right? With an investable period of 3 to 5 years again. There are AIFs which invest into real estate because India is a huge market. Not only in India, world over, this is one of the biggest investment vehicle, which is real estate funds, which invest into project funding, which become a co-funder to the project. Again, investment period has to be 3 to 5 years. Return can be 15 to 18 percentage based on the past return, historic return levels. There are global funds which can invest into stocks in emerging markets like China, Brazil, India, US, etc., Taiwan, etc. So there are global funds which can facilitate investment of Indians, of NRIs, of domestic people into global market, and the past return has been 10 to 14 percentage in US dollar terms. And there are global non-equity oriented AIFs which invest into insurance trading products, debt management product, etc. There are global investment avenues which is available for Indians today with a 8 to 10 percentage, 12 percentage US dollar return. Just keep it in mind the past return at no point is an assurance for future, but that is where investment experts can navigate, advise you rightly to suit right set of investment for your risk categorization. So there are ICICI, Motilal Oswal, ASK, Aditya Birla, Nippon. There are so many investment companies. So I'm skipping this slide, which is a repetition. And the fourth strategy, the big strategy is investing in International Financial Service Center. First International Financial Service Center facilitates the strategies Gift City in, it comes out of International Financial Service Centers Authority Bill of 2019, where Indians and NRIs are permitted to invest in global investment product via India's free trade zone called Gift City. So if the investment is done in US dollar or foreign currency, and these are set up within India. You remember earlier the Mauritius and Cayman Islands used to drive a lot of investment. Those kind of international jurisdictions are there in India too, where people are permitted to invest through these kind of a US dollar denominated investment options. The benefit. Let's look at some of the benefit of Gift City investments. So there are AIFs which predominantly operate out of Gift City, which has got a tax pass through based on the taxation aspect of the country where you're resident. For example, if you are a resident of UAE and investing into equity schemes, possibly if UAE doesn't have an equity taxation on that, so you virtually get your investment return with zero tax if you're a TRC of UAE. So foreign investors in India with no other income, any income arising out of the investments are not taxable in India. Non-resident investors are not required to obtain a PAN. So here you can invest in Gift City route, International Financial Center without a PAN number. No GST there. The fourth point you can see no GST, no STT, no commodity CTT, etc. In IFC related transactions. Even so, thereby a lot of benefits to the investor, especially for those NRIs and Indian investors. Yes, subject to certain taxation and foreign exchange rules, right? They are willing. There are investment vehicles which you can invest via Gift City route, and they can invest into India via Gift City. They can invest into the world via Gift City. So there are multiple alternative investment funds available to invest in Gift City route. So broadly, four investment strategies we have discussed. One, we discussed about mutual fund, an entry-level pooled vehicle where people can come invest for 1 day to say 10 year or more, for 500 rupees to 5,000 crore. We've seen the second type of investment, which is portfolio management service, which there is a personalized PMS manager, SEBI registered PMS manager, who decides investment strategy to invest your funds with a higher risk and higher return. The third one we talked about, alternative investments, which caters into five category, which is Indian equity, Indian debt, Indian real estate, foreign equity, and foreign non-equity or foreign debt. So there are five different vehicles in AIF to invest. The fourth strategy we have seen overboard is Gift City, International Financial Center investment, where Indians as well as NRIs are permitted to bring in dollar investment and take back in dollar. There is no GST, there is no STT, there are a lot of tax benefits coming out of it. So, having seen all this, are you a smart investor? Is what you should ask yourself. Or are you the traditional one who still hold only real estate, only gold, only FD, only chit funds? Or are you, have you made a difference? So, today, we in this profession are able to see so many people have transformed their lives into from traditional way of investment to their counterparties. So, just look at some of it. Very interesting one. Typically, a bank deposit, there are customers still hold a high amount of bank deposit and still have high regard to the bank deposit. Today, from a bank deposits, people are changing to within fixed income securities like NCD, non-convertible debentures, mutual fund, debt schemes. There are brilliant mutual fund debt schemes. What gives you a kind of equity debt combinations with equity taxation. We're going to cover the equity taxation subsequently. There are structured investments, which is a debt plus equity combinations, giving you a higher amount of return. And there are credit opportunity funds in AIF, again, works like a debt fund, but gives you a higher amount of return from the debt instruments. So, while you should understand that a bank, what typically does, getting your deposit and assuring you a fixed income and lends this money at a higher interest rate to the needy. And the remaining profit largely is booked by the bank only, where I also worked. While that is the right thing, and they do a lot of justice to that because they lend money to so many people to grow their businesses, build homes, etc., etc. But from a smart investor point of view, you may want to look at it a segregated portfolio or a differentiated portfolio. Not segregation is the right word, diversified portfolio into FD, into NCD, into mutual fund debt scheme, into structured product, into AIF, so that your overall yield on the investment, instead of putting 100 rupee into an FD, breaking that into 4 or 5 investments can increase the return on your investment. So here is another set of smart investor who used to have only real property, real estate property, which means the tangible real estate property. residential sites or commercial sites, and with a low liquidity and higher taxation or higher amount of transaction tax, is moving to real estate funds. They become a co-developer. They become a funder to projects like real estate residential project or a commercial project. There are some of the funds which is mentioned here, which is able to give a better return than a pure real estate stuck up real estate investment, which means a building under your ownership. Here, that fund will allocate ownership to you, not the real brick and mortar structure. So you are able to better your investment return and with a steady income from that real estate funds. People who are fascinated with gold and continue to have a diversified portfolio in gold now are moving from physical gold to digital gold. In gold ETF, in when sovereign gold bond was there, that was a big success. Gold saving scheme. So people are moving from holding physical gold and limiting their liquidity to they're moving into electronic gold. So whichever in affluent class or life cycle class you are in, if you're a beginner, there will be a separate product recommended to you. If you are an affluent and a grown matured investor, you may look at it products like investment options, investment vehicles like this. If you're a high net worth customer, your investment style can differentiate like PMS, structured products, etc. If you're an ultra HNI, should look at it alternative investments, global funds, etc. So anywhere you want to create accelerated wealth, choose the right set of investment rather than keeping all your money in structure, I mean the old style of investment vehicles. So each of the program has got different return and the risk levels are different, regulators are different, and tax benefit is different. So I'm jumping this slide because multiple times you've seen. For NRIs also, please remember the NRIs who are listening to me today, please understand you're able to generate better return than in NRI FDs or FCNR by just leveraging that into NRI yield plus deposits or mutual funds or equity market. If you're able to take a higher amount of risk from nil risk, it has to go into a moderate or moderately high risk, which is all regulated market. So don't subscribe to something which is non-regulated, and taxation is still at your benefit. Benefit to you. So anybody who is in affluent category or an RA category should look at it your tax payability in a year from your fixed deposit, from your real estate income, etc., and compare that with mutual funds or equity schemes or real estate funds, etc. Because that is where the taxation is having a range from 30% to 12.5%. So 30% largely all fixed income securities have 30% taxation, where in which your mutual funds or equity products largely comes at a 12.5 long-term capital gain scheme. That is exactly here it is showing that there are three types of tax brackets are there broadly in India. So all interest income, capital rental incomes are all factored at a 30% tax rate, including the salary income. What it means is 30% is from if your income schemes are available in, if your disposable income in a year is above 15 lakh, then this would be the tax rate will be applicable. But when it comes to gold, then your tax rate comes to 20. Including real estate now with the latest amendment and stocks, your capital gain is now coming to 12.5%. Of course, tax is a complex subject. You would require a chartered accountant support to ensure that your taxes are calculated correctly. This I'm just telling you an indicative way of calculating taxability of different income coming out of equity schemes, coming out of gold and related schemes, coming out of fixed income securities like bank FDs. Just to drive the point, if you are able to get a X percentage return from FD, your hybrid mutual fund very likely to give you a 2x return, or an equity mutual fund or AIF can give a 3x return. Because this tax, I mean, return, annual return calculated is also considered here, and the tax which you pay. There are double impact from your tax coming in favor for this mutual funds or equity schemes. This I started saying that 5R policy is very, very important for us. First, you must ask your investment advisor what is the risk associated with any investment before you venture into. Then only you should get into, you should even look at your return. And then only with a regulated fund you should invest into, and you should review your investment once in a quarter or once in 6 months. Don't leave your investment half managed by anyone. So question your fund manager, question your advisor, question your wealth manager to ensure that you are getting the right set of investment, I mean return, with the right set of risk associated with it every quarter, at least once in a quarter. Now, we added this slide because I understand many of you will have a concern saying the markets are having a downturn. So, is it going to be the end of everything? So, this gives you a 30 years cushion, right? Or a 25 years market movements. So you can see this yellow marked areas where, due to whatsoever reason which is mentioned there, market had a similar kind of a dip what you're experiencing it today. The highest dip has happened, you can see, during the COVID time, and even what you are currently going through is also, it is not the first time market is experiencing this kind of a temporary corrections. And you can see further graph has built over in a year or so, or a 2 year, depending upon which time period you are in. So COVID time, you can see the shortest gap, and then immediately the market revived and started delivering a much higher return. So I think India is in a very, very different stage now, with large amount of investment coming in, having growing at the highest level of GDP growth in a year, and very stable policies, stable government, lot of government spending on the infrastructure and other areas. Having focused on global competitiveness index, also India would have become a better country now, with world-class manufacturing is taking place in the country. So India's ability to rebound to this kind of a temporary setback is very, very high now. And again, a point of discussion is, don't get into frauds, because people will offer you free trading and giving you trading income from securities, from commodities, from foreign exchange schemes, and from what, banking frauds, credit card frauds. So be aware about, you ask that another three more questions. Even if my firm is talking to your people, or your, our RMs are talking to you, ask for every clarity before you ensure that you cut a check or you cut an investment, because it's hard-earned money of you. Nobody in the world can give you a free lunch. So please understand that, and take all due review before you decide to invest into, and ensure that once in 3 months you should spend half an hour to review your financial status of your investment, or your loans, or your risk management tools, or your retirement planning, or your trading strategies. Whatever it is, you should spend your time on understanding the market. So this is a humble slide to NRIs. I think you can take a photograph of this if you wish to. Visit your bank and update your KYC. If your KYCs are not updated, bank or other security companies will put your demat account, bank account, trading account, everything under freeze status. Ensure your PAN and the Aadhaar is linked. India is advanced in terms of digital architecture as far as Aadhaar and PAN, the digital KYC is concerned. So without this, generally you will not be able to transact anything. So please spend and go to the bank or go to Akshaya Center first Everybody will keep for the last minute, and what happens generally is that if there is some rectifications required, you don't get time to convert your bank accounts into NRO or NRE, depending upon you would have opened while you were working in India. Ensure that those accounts are converted into NRO or NRE. EMIs are reinstated to that account. Loan closure documents you collect. All your demat account. This is where you should be careful about your all the demat account might have shares, might have mutual fund. Unless you correct your KYC and upgrade your accounts to NRO or NRE, etc., you may not be able to transact from that account. And not only in demand, but MF, insurance, all that one status have to be changed accordingly. And Indian mobile number should be linked to your Aadhaar, etc. So that OTP, everything in India largely works on. Did you know that 76% of India's transactions, financial transaction, happens online? Many other countries cannot take this kind of a credit for 76 percentage of or larger 80 percentage of transactions happening through digital banking. So get your OTP registered, update nomination, and renew your processes, your schemes, your insurance, your FD, stocks, etc. in time. You must give nomination. This is applicable to everyone. Ensure nominations are given in all sorts of financial transactions so that there is a seamless transfer of wealth when something happens to you to the next generation. We were very happy when recently one of our customers, after the expiry, the transmission has happened less than a month's time to the nominee. And I'm very thankful that in their nomination process took seamlessly and able to transmit. So we see real life of people struggling where nominations were not given and where disputes arises within the families, etc., and the amount gets stuck. Same is the case with the locker. Same is the case with insurance policies. This is all applicable to Indians, domestic, everyone. And will creation, as much as possible, wealth transmission should happen seamlessly through the will registered wills. I know after with our experience of advising or working with foreign clients, NRI clients, that many of the countries do not have this nomination facility. So your will system will work seamlessly. So create will for overseas investments as well. All documents should be under safe custody too. So just to sum up, I know it has exceeded 5 or 7 minutes, uh, but just to sum up, financial planning is an important activity for each of us, moving away from the past to present. Adopt wealth creation strategies in a smarter way. Move away from traditional way of investing to smarter way of investing, even if you don't want to change the strategy. But wealth acceleration will happen through different market linked strategies or a diversification strategies. Accelerate wealth in the next 20-25 years, where India will become a Vikasit Bharat tag, and Indian GDP and also per capita income is expected to go up multiple times in the next 20-25 years. Life has many uncertainties and risks. Protect them from all the aspects. While I understand loans, insurance, and retirement, we haven't covered largely because of the time constraint. And like I mentioned, one thing, multiple things cannot be covered in one webinar. So we will conduct further sessions depending upon your feedback. So loans are a good tool, but use it effectively. Uncertainties, do cover it up. Retirement is certain, and life expectancy we have seen 80, 85, 90. So plan for a longer life, longer time period to live, and take tax benefit wherever it's required. So we are a registered MFT, and we are a financial management firm with different bank types, etc. But I wanted to read out this one particularly to you, that this important disclaimer that mutual fund or any equity market investment or any investment for that matter, investment has market risk. Read all scheme related documents carefully, and be ask all questions before you take a decision to take up. So this is not a solicitation to invest into any scheme, but to give you broadly the structure of investments, of ways and means to invest. So we believe our core values. Soumya, do you want to cover this?
Yes, thank you, sir. So, coming to our core values, which is our vision, we believe in enhancing the financial well being of individuals, families, and institutions with best in class practices. Our mission is to pursue excellence in our products, services, and processes, and people with focus on good for customers and good for us. We strongly stand for our values. We believe in our core values, which is trust, transparency, and ethics in all our transactions and dealings with our stakeholders. So these are our core values and principles that Trinity Finvest stands for. And you would wonder why Trinity Finvest. Trinity Finvest is a one-stop solution, a financial shop with all the products and services exclusively for our customers to make their financial transactions easy, transparent, and our rich experience in banking and financial industry gives us an edge in terms of accommodating all their services and managing their financial well-being. And we have best in class products and industry tie-ups, which shows that we are credible, and we believe in consistently enhancing the quality of products that bring about with our strong associations in the industry. We have technology, our technology partner, Asset Plus, for the convenience of our customers. So at a finger touch, you can see how your portfolios perform, and we share quarterly reviews to ensure that you know how your portfolios are performing, and all your concerns are addressed on a timely basis. And we maintain the confidentiality of our clients. So even between husband and wife, we treat them as two different individuals, and we ensure that the confidentiality is maintained. And we believe in a lifelong relationship. We're not looking at mere transactional relationships, we're looking at long term relationships. And we have very well researched products and solutions under us. And our periodic review stands out. I'm sure many of you who have joined us knows about this. And coming to our products and solutions, under investments, we have fixed income products, mutual funds, portfolio management service, which is otherwise known as PMS, alternate investment funds, which is AIF, global investments, structured products, retirement solutions. And under demat and trading, we have equity trading, derivatives trading, commodities trading, currency trading. Under protection or de-risking, we have life insurance, health insurance, corporate and industrial insurance. And under banking advisory, we have loan syndication and restructuring, SME loans, educational loans, as well as loan against properties. And we have the social commitment of empowering our society at large. So we have FinSeed for the financial education of students, as well as we have a foundation which is Trinity Love and Care Foundation, because we believe in giving back to our society. And apart from that, we are also dealing with tax planning and advisory, as well as succession and business continuity planning. These are the latest additions in our services. And we have technology to empower you. We are partnering with a fintech company, which is called Value Plus, and they provide best in class mobile applications. Many of you are familiar, Asset Plus. Which makes it easier to process your online KYC, your financial goal setting, importing. You can even view your outside investments on the app, as well as track the growth of your portfolios. And we have very strong service partners. So amongst 3,500 mutual funds, we have mutual fund partners, six key partners in the alternate investment fund category, six key partnering banks for the loans and banking, and we have best in trading and technology platforms. So these are the service partners that we have associated, and I'm sure you are very familiar with most of the names. So it's important to get your financial health checkup done just the way you would do your regular medical checkup. It's important to view and understand how your finances are performing versus inflation versus the current market condition. Are we geared up for wealth creation in terms of diversifying our portfolios? So that's pretty much what Trinity Finvest offers you. And I'm hoping all of you have found this session quite informative. I think GB sir has covered it exclusively and in depth regarding all the topics which would be of interest, especially for the NRI and HNI category. So now the dice is open for a question and answer session. So some of you have already texted some questions, and we will address them. And also, we will also take questions in this session. Over to you, GB sir.
Yeah. Thank you. I have the team has given me a print which says Mr. Subramanian Ramaya has asked for. People have many accounts like NR, resident, NRE, and NRO. It'll be great to know the advantage of choosing investment, which accounts, and 80% of the people invest for retirement and children, etc. So that the investor who are residing abroad are back at their home country in the scenario which is suitable account where the money is in it. So, yeah, this is a very important point which Mr. Subramaniam is bringing in, saying that customers, many of our customers, many of the people who were working in India and have their SB account, savings bank account, and went abroad. Now, after several years, also they have not moved their account to NRE, NRO. Also, let me tell you that the government has given you so much of freedom or free much benefit to the NRIs to manage to get a repatriation of that account, repatriation of the money from those accounts freely, so that they have to maintain only an NRE account for all overseas remittance income, and NRO account for any Indian income to be credited, etc. So please exercise your authority, your right to get accounts reclassified as NRE or NRO or FCNR, as the case may be, as far as NRIs are concerned. For domestic, for all of us in India, we don't have to worry about this. This question applies to NREs, because your repatriability, money taking back to any other country, become much more freer, much more freely possible with an NRI and NRO background. I hope I was able to answer that question. And individually, if any advices which you require, you can always reach out to us. Mr. Joby Matthew has asked a question. Please suggest few guaranteed return investment for short-term periods like 3 years or maximum 5 years. I'm not looking for long-term investment. Okay. So guaranteed income, like I mentioned, people have moved. So one is of course fixed deposit, but that is a traditional way of investing in guaranteed income. Now there are multiple investments starting from non-convertible debentures, which is corporate debentures, to guaranteed income plans of insurance companies, and third, mutual fund, government security investments, G6 investment, or a short-term debt investments. While it is not guaranteed, so I disqualify from the point that it is not guaranteed, but then it is reasonably in a range bound. If you can consider that also as part of guarantee, yes, it is reasonably range bound, because mutual funds are not permitted to guarantee any scheme. There are structured investment, which is again semi-guaranteed kind of an investment, and there are credit funds which are not guaranteed by nature, I mean by word, but in nature, those investment into real estate, those investment into credit risk fund, etc. You can see a range of return which is from better than FD, and it stays for 3 to 5 year minimum investment period. So there are multiple schemes available. I don't want to take names in this forum because this is not intended to draw any sales pitch. So it is just to give you a broader perspective about the market. Hence, there are multiple schemes available, which we will be able to advise you, or your wealth manager will be able to advise you. And Mr. Kaushin has asked, a question: how to select an investment with good return and stability in the volatile market, like sovereign gold bond, ETF, mutual fund, direct investment into shares, small case, or better areas. In mutual fund, lump sum or SIP for a given duration. So the question is broad. The question generally, what I understand, for long term good return, what is the type of investment? Mr. Kaushik, there are an empty number of investment strategies starting from a pure equity basket, like small case I can refer to, or a portfolio managed portfolio PMS, or a mutual fund scheme, or an alternative investment scheme. So there are multiple long-term wealth creators depending on your risk appetite, depending upon the duration of time which you want to keep it, depending upon when you want to exercise the tenure which you are looking for. Your wealth manager or our firm will be able to create a customized scheme for you that you should look out for. But there are enough and more opportunity available to create wealth on a long term basis. I'll move to the fourth question, Mr. Padma Kumar has asked for. I'm currently working in X Place, have good investments in mutual fund. Would like to know how mid cap and small cap stocks will perform going forward. Okay, this is very difficult future forward, future looking statement, wherein which whether it is good stock, whether it is large cap, whether it is small cap, whether it is mid cap, will do well if the fundamentals are right. For example, if there is an industry where in which the company exists and company has a strong capital, board of governance, corporate policies, strategic management, the company can do well irrespective of that mid cap segment doing bad or small cap segment doing bad. If your question is about valuation of the industry, yes, mid caps and small caps are still on a high premium. So thereby, it is scheme specific. It is not broadly like all mid cap will fall tomorrow or small cap will fall tomorrow and large cap will grow tomorrow. It is not that way. It is about a scheme. It is about how much diversification you bring in. Like I mentioned in all my slides, you would have seen past performance should not be, need not be the indicator for future. So you will have to be careful. Active managing your scheme is important, and to you should know where to cut it off and come down, book your profit. From your mutual fund schemes, like you have mentioned, to book the profit from certain funds and reallocate your portfolio depending upon the changing risk climate in the market. So these were the couple of questions which has come in the chat box. Anybody want to ask any questions? Free to answer. Next 1 or 2 minutes, so that we can wind up. While we've exceeded by another half an hour or so, but we should Saturday evening. All of you are spending time, so we should help you to if there is any question which we can answer, we'll be happy to answer.
Thank you all for joining us today. I know it's a weekend and probably you're trying to wind up your weekend, but if there's any questions that you have on your mind, this is your time to just shoot those questions. Anything on the session or anything in general that you would like to clarify with regarding to any of the topics covered today, you can even reach out to us on the numbers which is shared in the message box. And our corporate office is located in Kakinad in Seaport Airport Road, and I've shared the address. Please do share your valuable feedback in the Google link which has been shared in the message box. So we thank all of you who have joined the session today. I hope you found it immensely beneficial, and I'm sure it has empowered you to make more wiser and smarter investment to accelerate your wealth. So I think there are no
Yeah,
much questions, so probably they are done
yeah.
for today. Let's wind up. And
So thank you very much, each of you, for spending the evening with us. I hope we did justice to the event, and do send us your feedback and be in touch with us to stay connected, get updated, and take wiser decision on financial management. Thank you.